What if I told you that even though you're doing everything right, working hard, planning for retirement, and contributing when you can, there's still a chance you're not allowed to put money into a Roth IRA? Yeah, I know that sounds ridiculous, but for many federal and postal employees, it's the truth. So we're going to talk about this coming up. The Benefit Coordinators really enjoys producing these videos for you. If you enjoy them also, please consider clicking the like and the subscribe buttons. Also, clicking the chime will notify you of our new posts on Saturdays. Let's talk about the Roth IRA limitations, what they are, how they impact you, and what you can do if your income is too high to qualify. Because the last thing that you want to get hit with is tax penalties or miss out on one of the most powerful retirement tools that is out there. And if you ever felt confused by all these income thresholds and contribution rules, you're not alone. That's exactly why we're here, to break things down clearly without the jargon so you feel confident about your next move. So let's start with the absolute basics. A Roth IRA is a retirement account, but it's not just any retirement account. It's a special retirement account because the money you put in grows tax-free. And when you retire, you can take it out tax-free too. Sounds like a dream, right? Well, there is a catch. Not everyone is allowed to contribute to one. The IRS sets up limits on how much you can contribute and how much you can put into a Roth IRA each year. And unfortunately, the more you earn, the more complicated it gets. If you're a federal or postal employee with a stable job and some years of service, there's a good chance your income might be bumping up against those limitations and maybe even exceeding them. So here's what the numbers look like in 2025. If you're single and your modified gross income is below $146,000, you're in the clear. You can contribute the full amount, which is $7,000 or $8,000 if you're 50 or older. If your adjusted gross income is between $146,000 and $161,000, I know that sounds like a lot of money, your contribution starts getting reduced. And once you hit $161,000, you can't contribute at all. If you're married or filing jointly, then your full contribution limit cuts off at $230,000, and beyond $240,000, same deal, you're locked out. So what can you do if you're earning too much? Quit your job. No, seriously. Don't panic. Don't panic. Just because you're past the limit doesn't mean you're out of options. In fact, this is where things get actually interesting. There's a back door to your Roth IRA. It's not shady, I promise you that. It's actually a legal workaround that many higher income earners use. And here's actually how it works. You put money into a traditional IRA, which doesn't have an income limit. Then you convert that money into a Roth IRA. Simple as that. Sounds really simple, doesn't it? Yep. Now, there are taxes involved during the conversion, so it's not perfect move for everyone. But federal employees who don't want to miss out on tax-free growth, it's really worth exploring. This is also where it's helpful to talk to someone who understands federal benefits, someone who grows and gets the TSP options that you work with every single day, someone who knows how your pension, Social Security, and insurance play into the bigger retirement picture. In case you don't get it, that's us folks at the Benefit Coordinators. We help folks like you all the time through the Benefit Coordinators. We're just saying you need to get back to us. Now let's get back to the Roth component. Here's something many federal and postal employees get confused about. Roth IRA versus the Roth TSP. They sound the same, but they are very different. Your Roth TSP doesn't have income limits. That's because you can contribute no matter how much you earn. You can contribute a bunch of money. So the Roth TSP is great, especially since it's payroll deducted and you get agency matching, although not in the Roth component, but the investment options are limited and you retire, and when you retire, distributions follow different rules than a Roth IRA. So you should contribute to a Roth IRA and a Roth TSP if your income allows it. It gives you more flexibility in retirement. The Roth IRA has more investment choices, and unlike the Roth TSP, it's not subject to the required minimum distributions at age 73. But what if your income is already maxed? Well, that's where you plan smart. You can start with your Roth TSP, max it out if you can, then look at the backdoor Roth strategy we explained earlier. And if you still want an extra layer of tax-free growth, well, those are things that we need to consider. So let's be real. Federal employees are often told that their pension and their TSP will be enough. But with rising costs, inflation, and longer life expectancy, you know that's simply not true. The truth is you have to do more than what's standard, and if you want to retire comfortably and not feel stuck later. Let me go off script here a minute, and say, have you ever heard anyone complain about retiring with too much money? I never have. Think about it. And this is what this thing is all about. It's not just about income limits and contribution caps. We are all about making sure that every tool is available to you on your terms. So before we wrap up, let's go over a quick few tips. Know your maximum adjusted income. It's not the same as your salary. You can find out what it is on your tax return. Understanding this number helps you plan better. Contribute early. Roth IRAs grow over time. The sooner you fund it, the more time it has to grow tax-free. Check your eligibility every single year. Income thresholds change. What disqualified you this year might not disqualify you next year. Number 4, use your Roth TSP to your fullest if you can't do a Roth IRA. And don't forget the TSP is a powerful tool, especially with matching. Number 5, talk to someone who knows federal benefits. Seriously, don't rely on general advice or talking to a coworker. Your benefits are different and your plan should be too. We know this stuff can be confusing, and it's why so many federal employees just set it aside until it's too late to do anything. And then we hear all the time, I wish I had done this sooner. But it doesn't have to be that way. With a little clarity and the right people in your corner, you can take control of your retirement strategy, even if the IRS tries to make it harder. And if you need help sorting it all out, well, you know where you can find us. The benefit coordinators work with federal and postal employees every single day. We know the system, we know the rules, and more importantly, we know how to make them work for you. Because retirement shouldn't be confusing, it should be something to look forward to.